So just a quick question on like either tender or secondary offer for primarily employee shares. Just any guideposts on what the typical discount is to the last price round? I know you mentioned you price it right at the last preferred round, and everyone seems happy. But do these tend to price at 60% discount?
I don't know.
1% discount?
Let Stefan, who's more of the banker among us, I have a view, but once you start, Stefan,
Yeah, well, look, this is an incredibly complex question because it really depends on, like, you know, the liquidity pref structure in place and the capital structure in place for that particular company, right? And you know, the answer, like if you look at market prices today, you know, it really ranges from like 40–50% discount at the high end to like no discount at the low end, I would say. I think what's really important to me is that there is a mechanism to find that price, and what's really important there is from a regulatory standpoint, so that you're not running risks of, because you're negotiating on behalf of your employees, usually management is involved in that negotiation. Usually secondary transactions happen in conjunction with a primary transaction. I mean, that's like the norm recently. Pref structure, a lot of, like I as an investor, I loved buying common shares because I felt like the pref structure was always overvalued. Because a lot of those companies, either they're zeros or they're successful, and a lot of them have that on the balance sheet anyway. So if something goes wrong, you know, the pref structure is usually not worth like the discount that I get buying common shares. So I think that's where, from a regulatory standpoint, I just would be very careful. But ultimately, there are so many different factors that influence that there's no common like formula that you can use. And I like John.
But the one rule of thumb I would say is the discount declines as the valuation increases. Okay, so if you're at a valuation of $100 million, you know, 20 to 30% is a pretty common, maybe even more, but something in that range. And if you're at $1 billion or more, then it starts to get very close to zero at the end of the day. And there are a couple ways to solve it, and I'll go back to Etsy for a second. So when Excel invested first, they bought primary because they couldn't come to an agreement on the discount. The company wanted to do some secondary, and Excel and the company couldn't agree with the employees on the discount. So what happened is Excel, let's say, I forget exactly the number, but let's say they invested $50 million, and 40 of that was for operating, and 10 million of that was designated for an Etsy-led secondary. Okay, so Excel got the benefit of the preference, and I don't know what the share price was, but the secondary wasn't the same price as the preferred, but it was done by the company. So Excel didn't buy common, so they didn't have to say what the discount was. When Tiger came in, it was at a much higher valuation, it was closer to $1 billion, and so Tiger was very happy, basically, to have the same price as the preferred on a per share basis as the common, because at that point the preference stack was, you know, less than 15 or 20% of the overall market cap of the company. So there are two very different ways to structure it. And we did one, for example, we were investors in a company called Indeed, and that never really needed to raise money. It was profitable very quickly on an operating basis. And we couldn't agree, so that then they wanted to sell some secondary in the company, and we couldn't agree with them on a discount. So we just bought primary preferred. I think it was $15 million or something like that, and then the company ran a secondary at the same price. We didn't care what the price was really at that point because we had our preference, and it was sort of in a 250 million valuation range.